What's good, YouTube? Welcome back to the Stock Hustle channel with your boy William. Today is Wednesday, November the 10th. As always, guys, nothing that is discussed on the channel is financial advice. It is simply financial education. Simply trying to show and teach people you don't have to slave in that 9 to 5. You can easily hustle 24/7 in the market and still be able to achieve all those financial goals or aspirations you have for yourself. As with anything else in life, you're going to get out whatever you put in. But here we're going to focus on the education, good karma, and good vibes, and trying to teach people, as many people as possible, for free, I might add, to be as profitable as possible in the market. But to save time, let's get into it. So today's video is going to be a little different, guys. For all my experienced investors or all my experienced option traders, this video may be one you may not want to watch. I'm actually going to categorize it under the newbie section or the new investor section or playlist that I have on my channel page now, specifically because I want to bridge a gap that I keep getting asked in various places on social media, right? And I want to be able to try to help not only interpret what happened today for those that are new, but also kind of understand you have to have some fundamentals in certain areas to be able to tie all this together. You don't have to be the expert of everything to do it. You just have to have some ground rules that you need to formulate for yourself, right? And this is for yourself because, again, no one trader or no two traders trade the same, right? I have a perspective, somebody else might have something completely different, right, that works for them. I'm bullish, someone else may be bearish, right, et cetera, et cetera. So you kind of have to formulate your own rules once you kind of get the fundamentals down under your belt. That'll help you become a better, well-rounded trader, right? So this is an indices map for those of you that don't know or haven't seen any of my videos. I used to start with the indices map just to kind of show what the kind of day it was, right? Obviously, you can instantly tell from the chart it was a red day, right? Now, are red days bad days? No. In my opinion, they are not. In my opinion, red days are good days. Why? Because red days present opportunities to you, right? Think of it like going to the mall or going to Walmart or going to your favorite store and you walk in and everything is 50% off. Let's just say as an example, right? Obviously, if that were the case, you're going to buy everything you've been wanting or needing in your life now, right? Why? Because why would you pay more when you can pay less, right? Stock market's the same way. The fundamental rule of the stock market is you buy low, you sell high. That's how this works, right? That's how you become profitable. If you can master that skill, you become profitable long term, and you could even be wealthy, right? Especially if you can start reading and understanding what the crowd is doing or thinking, right? Specifically. So what led to today's red day? Let's start there, right? So specifically, there is something called a CPI index, right? Consumer Price Index, which is released at the start of every month, right? What is this index reporting, or what is it showing? Essentially, what it's reporting is inflation numbers. As you can see from the title here of this CNBC article, it says U.S. consumer prices jumped 6.2% in October, the biggest inflation surge in more than 30 years. Well, that's a pretty impactful title, right? Well, obviously, if you're like me, I don't trust everything the mainstream media says, to be frank. I take what they say with a grain of salt. If you've seen my videos, you already have that understanding. I like to verify what I'm being told. If you ever want to be able to pull this report, you can simply go to Google, type CPI data. On the very first item that pops up, you're going to see CPI Home, U.S. Bureau of Labor and Statistics. I already took the liberty of pulling it, and just in case anybody wants it, I will leave it in the details of my video below. This report here is essentially the inflation report. As you can see, it is a very, very well detailed, long 38-page report on essentially inflation, breaking down item by item and how much inflation is being applicable to each item. For example, right? Commodities less food, what is this? 2.2% increase. Services less rent or shelter, increase 1%. Durables 3.5%, and so forth and so forth. This is probably the most detailed report you have ever seen, if you've ever seen one, and it does give you very important information. Well, at the very top of this report, on page 1, literally last paragraph of the first page, the all item index rose 6.2% for the 12 months ending October, the largest 12-month increase since the period ending November 1990. Obviously, CNBC used a little bit more dramatic words, right, to make it seem that it's, again, it is 30 years. It's emphasized, right, and it's in big bold letters. So for anyone who is affluent or anyone who has a significant amount of money in the stock market, because remember, The top 1% own 80% of all the stocks, right? So they are the ones that hold the major stakes in a lot of these positions, right? They see stuff like this, and what do they instantly do? They sell their positions and take their money out of the market and go into the bond market. How do I know that? Well, there's something called the U.S. Treasury. You can look it up as a U.S. 10-year Treasury. Anytime that the U.S. Treasury has a spike, normally what that means is people are pulling money out of the stock market and they're going into the bond market. Specifically, actually, why is this one not updating correctly? It did show a spike earlier. Come on, Mac. What in the hell is going on? Well, earlier it was showing a spike. As you see it here, it shows a 1.2% increase. I'm not sure why it's showing a dive now. I mean, it may be after hours, but normally what you see when you see money running away from the market is you see a run straight into the bond market. Why? Bonds have a fixed interest rate that pay out. Obviously 1.5%. You see it increasing by 1.2. It's a pretty safe bet. If you put $1 million, you're going to get paid 1.5% back with no risk essentially to you, right? Why? Because the United States isn't going to go bankrupt anytime soon, making it a safer investment. But going back to this report, anytime you get inflation scares, that is the first thing you see. The one that pays the price are tech plays, anything tech related, anything speculation, anything new, anything that is disruptive. For example, look at any of the ARK ETFs that are basically steeped in speculation. They are the ones that get hit sometimes the hardest, right? With the correction we had in February through May, they're all Kathy Wood's ETFs took major hits. Why? Because they're steeped in tech and speculative plays. Today in the market, Apple, Google, Microsoft, Nvidia, right? All these tech giants took massive blows. One we just covered recently on the channel was UPST. If I could spell. Take a look at this. High tech play, AI driven, right? They do loans based on AI algorithms that are determining who can pay and who cannot, right? Trying to get people the best rate possible. Well, today, this company that has been on a massive tear since it went public, right? Going from the low 20s all the way up to the high 400s. Essentially today took a massive 18.21% hit. After smashing earnings, I might add, took a $57 drop to the share price. That tells you everything you need to know, right? Affluent clients see the surge in essentially inflation, makes them uncomfortable, makes them feel that they're going to get the rug pulled out from under them. So before they can get the rug pulled out, they pull the rug on us. You get a massive drop to the downside, and UPST is punished essentially for doing absolutely nothing, right? Some people find that to be unfair. But again, it's all in the way you choose to look at it, right? Your psychology is super important in the stock market, right? If you are a negative person that is constantly just getting bad vibes off everything, or feeding off bad vibes and producing bad vibes, please stay away from the stock market. This is not for you, right? That is not going to produce good outcomes for you, right? In my opinion. Again, nothing I say is fact, but again, this is my opinion, right? The people that thrive the best in the stock market are optimists, right? People who have a progressive mindset, right? People don't see this with a progressive mindset as a downfall. This is an opportunity. This is a sale. These rich and affluent people didn't appreciate this play and let it go and literally drop $57. That $57 you could easily scoop up, drop in a couple thousand, and you can now take advantage of a 50% or $57 gain per share potential, right? Again, this is the way you kind of need to see it in order to capitalize on opportunities, right? You pair that with a little bit of charting. And what do I mean by that? Well, take a look, first of all, right? If you watch any of my videos, one of the things I always try to reference is the trend is your friend. This play has literally been bouncing off the SMA, which is this white line, consistently, only having one false break, right? Before breaking trend up here. Once it broke trend, it then found support. Where did it find support? In this 342 to 307 channel, right? Okay, so what does that mean? Well, that means that's where it wants to be at right now, because it's consolidating and building a floor up until the inflation number hit and it dropped it out of that zone. But what does that tell you also? That it is fully capable of being here because it traded in this zone essentially from October 22nd through November the 9th, right? And it built the floor in the 300s. This is a relatively new play. Again, if you didn't catch the video on it, you're more than welcome to review it. It gives you a full fundamental basis of what UPST is and what they are capable of. I'm super bullish on this play, obviously. Just from the way I'm talking about it, you can tell, right? So what does that mean? Well, when you see things like this is an opportunity that you need to capitalize on, right? Yeah, there is an alert on unusual whales. It's actually like the third one down. Yeah, UPST 275 call, right? But it's bearish. So this probably means that someone is selling a call at 275, right? And again, I haven't gone into the flow. I haven't done any digging into UPST, so I don't necessarily know what this specifically alert is for. But what I do know is that at this price, it is on sale. Second thing you need to take note when you're charting or looking at opportunities based off of alerts, right? We're in a selling period on the MACD. The RSI essentially has shot all the way down to oversold. You have money flowing into this play because the accumulation distribution shows a spike to the top side. So people are seeing this and people are throwing money at it because why? They know this will go up. This is like your confirmation, right? And then you have your ATR or average true range showing you essentially a $52 swing. Now, it doesn't tell you which way it'll swing. It just tells you the size of the swing, right? 26 and 26 is 52. $52 potential swing to the upside. $52 potential swing to the downside, right? Specifically, after we did a $57 drop, $52 would bring it right into this ballpark of 307 to 342, which is exactly where we want to be. Now, pair that with the ability to play an option, right? Put that together. Now, let's say we didn't want to play the 19th. Let's say we wanted to give ourselves a little more time just for our own personal comfort. Easy. Go out a month. Go out to the December monthly, right? So what channel were we in that we said? Anywhere from 307 to 342. Go into the options chain. 307 to 342. Now you know your target, right? So 300, 340. Anywhere in here, right? And what stands out the most? Well, how about the ones that are spiking in volume? How about this 1307 spike in volume at the $300 strike? Essentially, you pay $1,120 or $1,160 at the ask, and you now have control of 100 shares of UPST, making $32 for every single dollar that UPST goes back up, right? Giving yourself a 32% chance to be profitable. But in reality, it's more than the 32%, right? Why? Because it's already been here. It's already accomplished this. It's not something out of the realm of possibilities. You can simply go back into the volume shelf and you can see, yeah, the concentration is from here from 213 down all the way to the 20s. However, look at the nodes up here. They're starting to build and climb. Why? Because people are buying at these numbers, which is now producing this shelf to become bigger. With time, if continuous people keep buying up at these higher dollar amounts, the shelf will shift and you will see this point of control line shift to the top side. That is what I mean about having fundamentals in charting, right? You don't have to be the expert. You just have to understand how shit works. And as long as you can do that correctly in a ballpark area and be able to put that together with crowd information, what crowds are doing, like what greater volumes of people are doing, you can then become profitable in the stock market relatively easy because it doesn't matter what the alert says. You will already know simply just by the fundamentals of the chart and from the fundamentals of the indicators what a play's potential is, right? And that's what I mean by bridging this gap. This is how you bridge this gap, right? I know if you're new, that seems really like impossible and hard. You're like, yeah, well, it's easy for you to say you've been trading for 10 years. Yeah, you're right. It is easy for me to say, right? But at one point in time, I was new just like you, right? And I'm trying to teach you to avoid to do my mistakes, right? What was one of the biggest mistakes I would make as a new retail investor? I would see red days as bad days. I would get down in the dumps. I'd be miserable. I'd be upset that my portfolio was red. And I would never understand, like, why did these people pull their money out when they know this stuff is going to go back up? Well, that's not the point. You need to think of it from the other side. Let them be scared. Let them be fearful. Let them go play something safe that they're not going to make any money on, and they're going to give you these gems. This is like finding a diamond, right? You just found a raw diamond. Now you need to go get it cut. Once you get it cut, you can get it set. Once you get it set, you can then use it to propose to anybody you want, right? And you have a perfect, flawless diamond. Simple. Again, this play is an opportunity. It's been presented to you. Now, what are you going to do with it? Are you going to let it just watch it or just not take advantage of it, right? Again, if you're really, really new, I would honestly not recommend putting money into a play, especially not something this high from the start. Instead, what I would probably recommend to you is go get you a paper account, either on Thinkorswim, on Webull. There are plenty of platforms that offer paper accounts, and trade on a paper account. What does that mean? Essentially, you're trading with monopoly money, right? You don't lose anything, but you don't gain anything. Well, what you do gain is experience, and experience is priceless. Why? Because it teaches you so many important, critical things that you won't learn any other way, right? 9 times out of 10, for a good trader to become good, they're going to have to lose some kind of money, right? Why? Because losing money is the best lesson ever. Why? Because you won't make that same mistake again. Literally, that is true, right? I'm firsthand witness and example of that. I lost a ton of money starting, but it taught me lessons to not make those mistakes again. And here I am now. Now I have a YouTube channel trying to teach other people how not to make those same mistakes, right? Again, you can take my advice as fact. Please don't treat anything I say as fact. Again, it is solely my opinion, but again, you can take what I say with a grain of salt. That's just my recommendation, right? Just some idiot on the YouTube talking about stocks. But outside of that, right, let's take a look at another one, right? So let's just go through this in alert and kind of try to break it down. I have this one hearted. So this is the Nielsen, right? NLSN, right? So let's take a look at Nielsen, right? We'll do this quickly because, again, for the sake of the video, I don't want to make it too long. I know you guys prefer the shorter videos, right? So what is the first thing you should look at in this play? If you see this alert, right, and you see that it's for a call at $25, you see that there is a spike in volume over open interest. That's good. You see that the expiration is essentially a little bit over 45 days out. It's not too bad, right? It is a bullish alert. It is on a monthly. It is on the ask side, okay? And there is a dividend involved, and this is a media play, right? So we got some important information on it. Actually, click on the alert. I like to do this personally. You don't necessarily have to. Again, nothing that I do you can treat as fact. Again, it is simply my opinion of things that I like to do. I like to break it down by minute because I want to see what's provoked the alert. Specifically, blue line is the ask, green line is going to be the price of the ticker, and then the yellow line or orange line is volume. Well, at approximately, what is this, 11 in the morning, there is this massive surge in volume. The ask automatically shoots up, right? Now we're at $55 per contract before leveling out. And then, as you see, as I've told you before, Unusual Whales isn't just alerting you of the spike in volume. It's also trying to get you the best price in the ask, because you can clearly see back here when it alerted, the ask was at 45 instead of alerting you up here at 55, saving you $10. That's a $10 you can use to pay your membership for Unusual Whales, for example, right? Again, just dropping some hints out there, right? But again, this is what triggered the alert. High volume, ask drop. The price of the ticker essentially stayed flat, ending at 21. Today, underlying was $21.11. So from this, what else do you look at, right? Well, the ask is 45. So we're talking about a $45 investment of a contract for control of 100 shares of Nielsen, right? Specifically. And I'm trying to go slow so I don't confuse anybody, but at this point, what I would do is I would take a look at the 10 big option trades, all right? What do we see? Buy a call, buy a call, buy a call, buy a call, buy a call. Now, at what amounts? So we got 4,000, 4,000, 20,000, all right? 20,000 being the biggest. You have 5, 3, 3, right? Now you have some sold calls also at 25, 3, 3, 10, and 9. So even if you put all of it together, the buy side still outweighs the sell side, right? Now, at this point, I would always take a look at the historical open interest versus volume, right? Because I want to understand the information of the option. So first and foremost, you see nothing in volume since essentially October 28th, leading up to today, the 10th, where you see this massive spike of 2,783. So there's some kind of urgency that all of a sudden, out of nowhere, people are putting money into this, that this will hit essentially $25, right? You see that the open interest is 706. So this tells you that 706 people who have shares of Nielsen are willing to part with 100 shares of their own shares at this specific strike, right? I believe this one is 25, right? Yeah, 25, right? So now from this, we don't have to go into the flow if you don't want to. Obviously, it's recommended so you can get a better interpretation of the flow. Again, we can duplicate a tab. We can go up here. We can go flow. We can go Nielsen, NLSN, Nielsen. We can go to filter, right? We can take off this floor trades. We can do a lower premium amount or take the premium completely out. right? And then we can filter and see some pie charts, and now we have a better understanding. All right, well, 1119 is the only contract being played, and you have 21 and 22 alerting. What is wrong? Why is that filtered that way? Oh, date range. There we go. Now, taking out the date range, now let's see what this is alerting, right? Here we go. So as you see, 1119 is bullish over bearish. Obviously, the most bullish is going to be January 2022, and at the strike is 25. Now this makes a little more sense, but now look at the pies. Pretty much all green, right? So at this point, what I would do is take a look at a chart specifically. Well, what do we see? The volume profile is here. You have the high side of the volume at 25.96. You have the low side at 19.11. Where is the point of control? Towards the lower side. What does the lower side consist of? That's essentially down here at this 1966. Take a look at the ticker. This is a 1 year look. So as of last year, essentially we were trading down in the 14s, hit the point of control, shot past it to the high side, right? And essentially lived up here from March all the way through middle of June before it started pulling us back down to earth. As I've stated to you guys, the point of control will always try to pull the price either down to it or up to it. And then we started consolidating essentially on our point of control from September all the way through, what is that? October 29th, before now we've started to separate. Now, take a look at the indicators. We're in a buying period. Our RSI is essentially at 60, so a little bit above neutral. Our accumulation distribution is accumulating money, pointing to the upside, and our swing is essentially alerting us that we have a $1.08 swing either to the top side or to the downside. Well, today, as of today, we closed at 21.17. The alert is for 25 for January. So at this point, what can we easily formulate? Well, being that we've been up here before and the volume nodes are pretty high, we can definitely get back to being up there because the volume is consistently spread out all the way through the 20s, literally all the way up until the $27 mark, right? I would be comfortable with that opinion at 27. So now that I understand that, let's take a look at the options chain. So again, this is alerting for January, right? So we would pull the January contracts. Let's take a look. Well, here you go. Here's your spike. 2,783 volume on 706 open interest. Again, alerting for the 25. Now, what else is comparable? Anything else? No. It is just this specific strike. So that would either lead you to believe this is one whale predicting that Nielsen will do this, either on information or financials that they may have, or other piece of information, or there has to be something that is giving them this understanding, right? Because otherwise what you see normally is a spread in contracts, right? You would see some at 20, some at 21, some at 22, some at 26, some at 25. No, this is a straight concentration at 25 only. That's, again, that should put up a flag to make you wonder. Take a look at the volume on the put side. Literally, it is zeros. There is 2 at 27. So that's pretty heavily bullish. Now, granted, that is in January. So let's take a look at December. We'll take a look at this. You have a volume spike here at the 23 and at the 22, both for December 17th, the monthly. Take a look at the put side. You have 171, not even close. Let's go back even further. Let's go to the November 19th, the most recent one. Now, majority is 0 only at the what? The 22 is their 470 contracts on 103 open interest. When you look at the put side, not even close, not even in the ballpark. Yeah, at this point, I would formulate the opinion this is very bullish. This is something potentially I would be willing to play. However, as you guys have seen, when I play options, I like to play a specific type of option, right? Number one, I focus on the delta, being 0.5 or better, giving myself a 50% chance to be profitable or better, right? Specifically. Number two, I don't like to go too far out because too many things can change. The sweet spot for me, this is for me is at least a week to 5 weeks out, right? Usually that's as far as I'll go on a short-term option when I'm really bullish on something and I want to predict that it will hit. I try to stay relatively close within points of volume control where I can see that the volume is in range. Obviously, this 25 is well within range. We've already been there. We've set there at least 3 months of the year. We're now sitting at the point of control, so we have the full capacity and ability to go and push to the top side. You start getting some money going into this, so we can verify right here in both the accumulation and ATR. That tells you, yeah, money is heading in. Obviously, with the RSI heading a little bit below overbought, yeah, it does have the potential to spike up and then cool back off before spiking up again, right? So essentially, you're looking at a scenario, if I can try to draw this real quick, where you may go up a little and then you may go and let the RSI cool. You may get a little bit of a pullback, right? Which may be right to the point of control or right above it. Before now being at neutral in the RSI, we then start to make a move essentially to the top side. Now again, please remember guys, this is speculation. Am I saying that this is what's going to happen? No. Am I trying to just paint an idea in your head? Yeah. Why? Because the indicators are telling us we're close to converging into a selling period. The RSI is going to hit this overbought. If it does, it's got to cool back down. So you would get a scenario like this. Go up a little bit, come down, and then shoot back up. Why? For that target of when did we say? January 19th, which if you're looking at the chart, this is January 19th, around where it needs to be. That's what your play would need to do to hit that $25 call, essentially, right? This is just one way you can get there. It could just be a straight shot. If tomorrow someone decides to wake up and put $100 million into this, right? Potentially, right? Again, there's a lot of different ways you can get there, but it's having the perspective and understanding of how something can be accomplished or acquired that's important. But again, guys, take it with a grain of salt. It's going to take a lot of work. Again, if you're really new to the market, please, before you start trading with real money, go trade on a paper account, learn the fundamentals, learn some indicators, learn some stuff before you start actually messing with money. Again, you don't have to take my word for it. That's just my opinion. I did it the opposite way. I did it with real money, and it cost me a lot. I wish I had that money back because, again, I would promise you I would make way better choices now at this point. But again, we each got to do or cut our own path or set our own trail, right, as they say. But I think you guys get the point. For any of you that still have questions, as always, leave it down in the comments below. Otherwise, guys, I will always catch you in the next one. Don't forget to like and subscribe to the video if you appreciate the message, or you can always hit me up on Twitter or IG. I'll catch you in the next one, guys. Peace.